The equity market might be tired, but still, tired equity markets can have legs. What's going to end this bull run, Roland?
We are not sharing the consensus, the super bull mood right now in the consensus. We think that a lot of good news are already priced in the US equity market. And one of the reasons we are not sharing this bullish view right now is that we think that the earnings momentum will fade soon. In fact, when you look at how the consensus has moved, analyst consensus over the last couple of months, we have seen a huge upgrade to take into account the tax reform impact. And we think that now upgrade is behind us, and we think that we're going to see a market that will be more under pressure of Fed rate hikes. We expect 3 rate hikes this year, and that will push the Fed fund rate at 2.25%, which will be above the dividend yield paid by the S&P 500. And also, it's going to be less attractive for companies to make share buybacks. For all these reasons, we are not big buyers, bull and big buyers of US equity markets.
You prefer Europe, but there is that risk of a less accommodative ECB. How do European equities weather that, Roland?
If you look in terms of valuation, and if you look at the fundamentals, clearly you want to buy European equities, but you got some headwinds. Stronger growth means a change in monetary policy, change from the ultra-accommodative monetary policy we have seen from the ECB, which means higher bond yield in Eurozone, and which means stronger euro. That's our headwinds for Eurozone equity markets.
And you're pro-core over peripherals. What's the reasoning for that?
First, if you look at in terms of valuation right now, you know, Italian, Spanish equity market used to be very, very attractive compared to the French or German equity market. Right now, you don't have this huge valuation gap. Secondly, if you look in terms of balance sheet credit quality, you got more credit quality, a better credit rating in the CAC 40, in the DAX, compared to the FTSE MIB or the IBEX. And as I say, if we have like some tension on the bond market, change in monetary policy, the end of the credit corporate bond purchase from the ECB, that will put some pressure also on the credit market. And thus, you prefer to be on high quality balance sheet. You find more in Germany and in France.
And let's talk about your sector allocation. You've been fine-tuning it. What measures have you implemented?
We keep the same direction. We think that the sector allocation, sector rotation is mainly driven by bond yield. So we are clearly continuing to invest into short duration sector. So we like the financials, we like the consumer discretionary, we like also materials, energy sector, and we stay away from the traditional defensive long duration. I mean utilities, telcos, real estate, and staples. All this sector, and that is interesting, underperform the market despite the performance negative year to date.